Welcome to Talk Tickers, your dedicated hub for dissecting earnings calls and really cutting through the noise of financial reports.
The goal.
Today, we're embarking on a deep dive into the latest from Mitsubishi Heavy Industries, a true global industrial powerhouse.
Absolutely, MHI.
We're looking at their Q1 FY 2025 results. That's April 1st to June 30th, 2025. And honestly, this wasn't just a good quarter.
Far from it.
It delivered some genuinely impressive numbers, signaling really robust operational momentum, a fantastic start to their fiscal year, actually.
When you look at these results, it's pretty clear we're not just seeing numbers. It's a compelling picture. Strategic execution that genuinely exceeded expectations.
Right.
It's sort of a story of how this highly diversified industrial player is capitalizing on, maybe even shaping, some major global trends. You know, energy transition, national security.
Big themes.
Huge. And the market reaction, it definitely seems to validate that narrative.
Okay, let's get right into the headline figures then, because they really do set the stage. MHI reported record high first quarter revenue and business profit.
Both records.
Yeah. Revenue climbed a significant 7.4% year over year. That brings it to $11,193.6 billion. But here's where it gets, really interesting.
The profit jump.
Exactly. Business profit surged an astounding 24.7% to $104.1 billion.
Wow, nearly 25%.
It's a huge jump, and it pushed their profit margin up to 8.7%. That's a 120 basis point improvement.
So 1.2 percentage points better profitability, that's significant.
It really is a clear signal of, enhanced efficiency, strategic focus paying off.
And that operational excellence, it filtered right down to the bottom line too. Net income also hit a record. $68.2 billion.
Up 9.5% year over year.
Yep. And what makes this particularly noteworthy, I think, is they managed this despite facing some pretty significant currency headwinds. We should probably unpack those later.
Definitely. We need to touch on that.
Earnings per share on an ADR basis, that's their American Depository Receipt for those listening.
Right. The U.S. listed share.
Came in at $7.14.
Yeah.
Beat the consensus estimate by 2 cents. Pretty solid beat.
Beat.
But for me, one of the most compelling indicators here, the free cash flow.
Yeah.
It turned positive, significantly positive, $64.3 billion.
That's a big swing. What does that tell you?
Well, it suggests really robust cash generation, which is, always a critical sign of a strong, healthy business, not just profit on paper.
Absolutely. Positive free cash flow is a massive green flag. And talk about future visibility. Order intake.
Huge numbers there, too.
Total order intake reached an impressive $1,768.6 billion. That's a lot of new business coming in the door.
And that feeds the backlog.
Exactly. It expanded their order backlog to a substantial $10,772.9 billion.
Just massive. Over 10 trillion yen.
Yeah, increased by over 500 billion just from the end of the last fiscal year. These figures, they speak volumes, right? Not just about current demand, but secured future revenue. A very long runway.
It truly does. A backlog like that provides incredible stability, predictability for their future operations. These aren't just big numbers. They signal a critical shift. MHI isn't just growing. They're becoming significantly more profitable and strategically positioned, especially in those key areas: global power demand, national security.
Okay, so let's really unpack these results. Let's understand the how behind these impressive numbers. The company's CFO, they highlighted that the record business profit and that crucial positive free cash flow were primarily driven by increased advances received.
Upfront payments.
Exactly. From strong order intake, especially pronounced in their gas turbine combined cycle division, GTCC.
A key power generation tech.
Right. So it's not just booking orders, it's the terms, getting paid upfront for future work.
That's a great point. And a powerful aspect of their model right now. Those advances really boost the cash position, help fund operations more efficiently. But is that just timing? Or does it show like a fundamental shift in negotiating power?
I think it's a bit of both, but mostly reflects the sheer strength of demand right now.
Makes sense if you have a critical product like GTCC.
You've got stronger leverage. Now, what's truly fascinating here is the segmental performance. We saw increased revenue and margins pretty much across the board. Energy systems, plants and infrastructure, aircraft, defense and space.
All showing improvement.
Yep. Drilling down into energy systems, that GTCC activity in North America was, exceptionally strong. 8 large frame GT units booked.
8. That's a huge number for large frame turbines. Those are the real workhorses for power generation.
Right.
And this isn't just about selling machinery. It's directly tied to that escalating demand for reliable electricity. Think AI infrastructure, data centers.
They need constant high-capacity power.
Exactly. And GTCC systems. They're efficient, reliable, a go-to solution. So MHI is like directly enabling that whole digital transformation.
That's a good way to put it.
And beyond GTCC, nuclear power also showed stable revenue and profit. That aligns perfectly with the growing global demand for reliable, lower carbon baseload energy. Nuclear is seeing a bit of a resurgence.
It seems to be. Countries want to decarbonize but need grid stability.
Precisely.
And then on the defense side, overall order intake was slightly down year over year.
But there's a reason for that.
Yeah,
Okay.
big one. Q1 last year, FY 2024, had an exceptionally high comparative base. Some massive bookings then.
So a tough comp.
Very tough. But even with that, the segment still maintained a high level of orders, actually exceeded its revenue this quarter.
Which means the defense backlog is still growing,
Yeah.
even with that tough comp.
Right. Signals robust future growth there, too. What's driving it? Well, Japan's ongoing defense buildup is a key factor.
Major spending increases there. Modernization efforts.
And MHI is a primary beneficiary, playing a pivotal role in those national security initiatives.
Yeah, makes sense. And what about the aero-structures side, the Boeing partnership?
Good news there, too. The 787 aero-structures business saw increased revenue and profit, mainly due to higher unit deliveries.
Okay, so positive signs for the aviation recovery as well. Production ramping up.
Seems like it. Now, let's address some of those macro factors they navigated. You mentioned currency earlier.
Right. The stronger yen, how much did that hurt?
Well, the company faced a negative 46 billion currency impact on business profit. That's directly from the stronger yen.
Okay, 6 billion. Not insignificant.
No. The average revenue recognition rate was 146 yen to the dollar this quarter, compared to 153 yen last year.
Ouch.
Yeah. But despite that pretty significant headwind, their underlying operational strength, their strategic execution, it allowed them to still achieve these record results. Shows real resilience.
It really does. It highlights that operational efficiency. To absorb a 6 billion currency hit and still deliver record profits, it means the core business performance was exceptionally strong.
Exactly. It's not just growth. It's profitable growth, even in a tough environment.
Okay, and speaking of external pressures,
Yeah.
U.S. tariffs, often a big concern for global players like MHI. How did they fare there?
Management stated the direct impact on Q1 was largely immaterial, in the tune of only several hundreds of millions of yen.
Okay, relatively small for their scale. But how do they manage that? That's the key.
Right. They're actively pursuing a cost pass-through strategy, both for major direct exports and for components imported by their U.S. subsidiaries.
Ah, the pass-through. So basically adjusting prices to cover the tariff costs.
Essentially, yes. Passing that increased cost along to the customer, insulating their own profit margins.
That's a crucial operational hedge. Shows proactive risk management.
Yeah.
They're not just reacting to policy swings. They're structured to mitigate them. That reinforces their confidence about managing it for the full year. Very smart.
It seems very effective. Okay, looking ahead then. The company reiterated its full-year FY 2025 guidance.
No changes there, despite the headwinds.
Nope. Still projecting $5.4 trillion in revenue, $420 billion in business profit, and a dividend of $24 per share. Split evenly, interim, and year-end.
And what exchange rate are they assuming for that?
That guidance assumes a USD/JPY rate of 145 yen to the dollar. So that's a key figure to watch going forward.
Right. But reiterating guidance, that really underscores management's confidence, doesn't it?
It certainly does. Signals they believe the underlying operational strength and demand drivers are robust enough to hit those annual targets.
Okay, so connecting all this to the bigger picture.
Yeah.
How did the market react?
Very positively, actually. Following the earnings call, the stock in Tokyo jumped 4.75% to 3,927. Trading volume was way up, too.
And the ADR.
Healthy gain there as well, up 5.3%. It really suggests investors are buying into this growth story, and the company's ability to execute.
Seems like it. They see a company that's well-positioned.
Yeah, and analysts were positive, too. Jefferies, for example, reiterated a buy rating. They specifically cited that margin improvement potential we talked about.
Makes sense. The messaging on limited tariff impact, the strong GTCC and nuclear commentary, that clearly resonated. Answered key questions.
Exactly. It provided clarity on those future drivers.
What really stands out to me here, though, is how strategically MHI is positioned. They're leveraging two incredibly durable engines of global growth, which Japan's defense buildup, which we mentioned, and the surging global power cycle, driven heavily by data centers, AI, industrial reshoring.
Right. The demand for power is just immense.
Immense. And MHI's huge order backlog in energy systems and plants and infrastructure, it directly supports these macro trends. They're not just watching these seismic shifts, they're actively providing the foundational infrastructure. It's like selling picks and shovels in this new gold rush for data and defense.
That's a great analogy. So what does this all really mean for you, the listener? It means MHI's strategy of incremental innovation things like higher efficiency GTCC upgrades, nuclear life extension services, it's really paying off.
Right. Practical innovation that drives margins.
Exactly. This focus leads to improved margins, even with currency pressures, shows strong execution, and their focus on critical decarbonization infrastructure and national security. Those provide really robust long-term tailwinds. They're not going away. They're building the future, quite literally.
Absolutely. And that return to positive free cash flow in Q1, plus the improved EBITDA margin, that indicates enhanced execution credibility in the market's eyes.
And it's not just the market feeling good?
No. The Japan Credit Rating Agency, JCR, recently affirmed their AA long-term rating. That underscores their rock-solid financial stability, low-risk profile.
So, looking ahead, what are the near-term catalysts people should watch?
Okay, definitely watch the consistent cadence of GTCC awards. How many more units do they book, especially in North America? Keep an eye on Japan's defense procurement milestones. Those signal continued government spending. And, of course, the ongoing trajectory of exchange rates. That'll remain a factor.
Got it. Those are the signals for continued strong performance.
Exactly. Confirming that strategic alignment.
All right, this brings us to the segment where we throw out an outrageous but plausible trade idea, strictly for entertainment.
Yeah.
Okay, certainly not investment advice.
Definitely not advice, just a thought experiment.
Given MHI's strong performance in energy systems, particularly GTCC, and that clear commentary on U.S. tariff mitigation, here's a thought. For those who like to think provocatively about market opportunities.
Okay, let's hear it. We're calling this the global grid enabler long-term play.
I like it.
So imagine exploring a long-term, maybe out-of-the-money call option spread on their ADR, MHVYF, targeting, say, a 12 to 18-month horizon.
Okay, what's the core idea?
The core idea is that the company's robust backlog in energy systems, especially those 8 new large-frame GT units in North America, provides this incredibly durable revenue stream, and it's directly tied to the escalating, almost insatiable demand for reliable power. Think AI infrastructure, industrial reshoring.
Right, the stuff we've been talking about.
Yeah.
And the limited tariff impact helps the margin side of that bet.
Exactly. It suggests a clear path for margin preservation, which is crucial for long-term profitability. Now, the wild aspect.
Yeah, what makes it outrageous?
We're betting that the sheer velocity of data center build-out globally, plus the accelerating pace of decarbonization, infrastructure spend, pushes GTCC awards beyond even their current impressive expectations.
Leading to upward guidance revisions.
Potentially, yeah.
Yeah.
Which could be a significant catalyst for the stock. That's the speculative bet.
Okay, interesting.
And to make it a true, speculative hedge fund style pitch, you could consider pairing this long MHI position with a short position on, say, a legacy utility player.
Okay.
Think of a company heavily exposed to slow growth regulated markets, burdened with huge capital expenditure for grid hardening, but lacking that direct exposure to the high-growth industrial and data center power build-out that MHI is tapping into.
So a bet on the enablers versus the recipients of downstream costs.
Precisely. A bet on the enablers of the new economy versus those just dealing with its consequences. Again, purely for speculative thought experiment fun.
Got it. Absolutely not financial advice. Okay, so to wrap up our deep dive today, Mitsubishi Heavy Industries delivered an exceptionally strong Q1 FY 2025.
No doubt about it.
Marked by record revenue, record business profit, robust order growth, impressive performance across key segments, energy systems, defense, and space. They're truly firing on all cylinders.
Demonstrating a compelling ability to execute their strategic vision.
And they haven't just reiterated full-year guidance. They've expressed clear confidence in their trajectory, their ability to navigate challenges like the stronger yen, U.S. tariffs.
Right. Their alignment with those powerful tailwinds, decarbonization infrastructure, national security, it sets a really clear and promising path forward for sustained growth. This is a company with its finger right on the pulse of global industrial transformation.
A truly compelling update from a company really at the forefront of these global trends.
Yeah.
As you continue to watch this space, maybe consider this. How might MHI's focus on the foundational infrastructure for AI and national security redefine what it means to be a heavy industry player in the 21st century?
Interesting question.
Yeah. Are we witnessing a shift where these traditional industrial giants become the silent, indispensable architects of our technological future? Something to think about.
Definitely something to mull over.
We encourage you to continue your own research, see how these insights might shape your understanding of the broader market and these critical industrial sectors. Remember, this information is purely for educational purposes.
It is not financial advice. Always consult a qualified professional before making any investment decisions.
Absolutely. We appreciate you joining us on Talk Tickers.